Hello, my name is Lee Presser. This is my show. I speak frequently to very interesting people. Some of these conversations are so exciting, so intellectually stimulating, I thought others might like to listen in. This is the reason we started recording Conversation with Lee Presser.
Welcome to Conversation with Lee Presser. Most people buy a house using a mortgage. The loan company buys the house with its money, and the homeowners who have signed for the loan repay the loan company through a series of monthly mortgage payments. After each payment, the homeowner's equity increases by the amount of the principal included in the payment. A reverse mortgage is a home loan that provides cash payments to the homeowners based on home equity. Homeowners normally defer repayment of this type of loan until they die, sell, or move out of the home. Our guest today is Pamela Gosser. She is a certified reverse mortgage professional with over 15 years of industry experience. Mrs. Gosser was the first person in Missouri to earn the CRMP designation from the National Reverse Mortgage Lenders Association. She is also a partner with All About St. Louis Seniors, a concierge service for seniors. Pamela Gosser, welcome to Conversation.
Thanks for having me.
So let's just start at the very beginning. We won't go all the way back to how you got involved in reverse mortgages.
Okay.
We can do that a little bit later on. But in the introduction, did I get it sort of right?
You got it right.
Okay. So now, I don't know, how do you normally start? What's the first question that people ask you?
So the first question is, how do I qualify? Do I qualify?
Well, first, for what?
For a reverse mortgage.
Right.
Right. So the reverse mortgage is designed for those homeowners 62 and older who have substantial equity in your home. You don't have to have the house paid off, but you do have to have equity. That allows you to tap into that equity, gives you cash in different forms. You can choose a monthly income, you can choose a line of credit, you can take the lump sum, which we don't really encourage unless it's absolutely necessary, or you can do a combination. So it's really designed in a way that's going to best fit whichever way or those needs.
Did I read that it is encouraged that you take from the reverse mortgage proceeds and pay off the house?
You have to.
That you have to do that.
You have to. So any
first mortgage or second mortgage.
Right, or mandatory obligations, which are anything tied to the house. So
any liens
mortgage,
of any
liens,
kind.
judgments, federal liens, anything like that that's going to show up on title will have to be taken care of before you can access any additional funds.
So the reverse mortgage then becomes the new first.
It is, yes.
First and only.
First and only, yes.
You can't do a second on that.
Correct. There are actually 2 liens that are put on the title so that you can't.
Really?
Yes, so there's the first one is for the investor, for the lender. The second one is for HUD. HUD actually goes on as the second lien holder.
And this is a HUD program?
It is.
Well, what is HUD, just
HUD
so
is
that for people who don't know?
Yes, so HUD is Housing and Urban Development. It is the FHA that you hear, government program. It is all insured. It insures a couple things. It ensures that if anything's going to happen to that lender, it's going to ensure that you're going to get your payments. Government's going to service that loan, make sure you get those payments. It also ensures that it's a non-recourse loan, which just means you'll never owe more than your house is worth.
Now, your company, you handle the reverse mortgages, but you're not the loaner then. It's not your money that's involved here.
Actually, Gershman does use their own money. So we are actually funding those loans, but then we are selling off the servicing of those loans.
The servicing.
The servicing. So someone else is going to buy that loan and service that loan.
Oh, so you get paid off right away then?
We do, yes.
Okay.
Yes. We generally know who it's going to at application.
All right.
Yeah.
All right, so somebody calls you up and they're like, Pam, somebody told me that you're really, this reverse, I need money, and they told me that I don't even understand this. Can I come talk to you? Then what?
Then we set up an appointment. I like to do face-to-face. I don't like to do much over the phone. I will. But I think if you've got a visual, because it's complicated. There's a lot of numbers involved. So you need to have that proposal and everything right in front of you so you can explain. It helps not only with me explaining it, how the program works, but it also helps you understand the program.
So this is not some sort of a phone thing that you could talk, somebody can call you up and learn about the program.
You could do it over the phone, and if some are more comfortable over the phone, it's fine.
But they can't see the numbers, they can't see the
I mean,
paperwork.
you send it out and mail it, and then you have another conversation later on. But I really like to do the face-to-face interviews. So.
Did I hear that before they come to see you, they're supposed to have spoken to some sort of counselor?
Well, they can. Getting the information is fine. You don't have to talk to that counselor before you come see me. A lot of clients come see me. I walk them through the program, and then I send them to counseling. Counseling is required, and it is.
Why don't you talk about that? What are we? Psychological counseling?
No.
What are we counseling on?
They're making sure you understand the program. They're also making sure that you've looked at all your options, that you're not just focused on the reverse, that you've looked at, hey, have you looked at selling your home? Have you looked at downsizing? They're going to look at, your income, your assets, and they're going to make sure that, one, you understand the program and that you are making an educated decision.
And they are sort of looking at you to see if you fully comprehend.
They are, yeah.
So that you don't
you have
wind
to
up,
pass the test.
so that you don't wind up having to deal with people who are judged not fully competent to make financial decisions.
Correct.
So let's just say they have gone through that process first.
Okay.
Then they pass the test. What do they get? A little grade card or something?
It's not a test. They're just looking for communication, making sure you're understanding. They're going to ask you questions as you go along, so it's not this stressful test. They just want to make sure you understand the program. After the counseling, they'll give you a certificate. That lets them know that you've passed. That lets us know, yes, you've had your counseling and you're ready to move forward.
Is this a free service, or you have to pay for this service?
It's usually $125. A lot of times it can be financed into the loan, or depending on when some of those agencies, they may have grant money available. So I always say, ask if they've got grant money. Some can qualify if, income-based. They may qualify for free counseling. So it's definitely out there, just if it's available or not.
So this counseling can happen before they contact you or after
Correct.
they contact you? It's not.
Correct.
There's no order to that.
Right.
Okay. So now let's just say they've done the counseling. They've not passed. They have been adjudged capable of making their own financial decisions. And now they come with their certified piece of paper and say, here, okay, Pam, now we start talking. What do we talk about?
So I'm going to find out, the big question is, why do you want to do this? So why do you want to do it, and why do you feel like you need to do it? To get a better understanding of why you want to do it helps me pick a program and help you choose a program that's going to best fit those needs.
And by program, you mean what you were describing earlier, the lump sum, the monthly, et cetera?
Right. So there are a couple of different ways you can take your money. There's also a couple different programs. There's a fixed rate that's out there that's a lump sum that I don't encourage anyone to do unless they've got a large mortgage payoff. And then there's a monthly adjustable or an annual adjustable program. Those are the programs that allow those different payment structures. Okay.
What is the most common plan?
The most common is the line of credit that I'm seeing right now. People are using those. With the line of credit, you actually have a growth rate on there. It matches whatever your current interest rate is, plus 1 1/4 of the mortgage insurance, because mortgage insurance is maintained throughout the life of the loan. And so you actually earn that as a growth rate in your line of credit. So over time, that line of credit is growing for you to use later on down the road.
So they're not really taking any kind of monthly annuity?
They don't have to, no.
Right, under the
we
line
do
of
have,
credit.
under the line of credit, right. And we do have those that take those monthly payments, whether it's guaranteed payments for the rest of their life, those 10-year payments, or term payments, a set number for a set number of years that they decide. So it's really, customizable. I mean, really.
On what is this all based?
So the amount that you qualify for is going to be based on the youngest person's age. So both borrowers need to be at least 62, the appraised value, and the current expected interest rate. So those factors go into calculating what you would qualify for. Normally, right now, you'll see 62 years old are going to qualify for about 56, 57% of the home value.
So if
And so the older you are, the more you get.
so let's just say you had 200,000. Let's do a $300,000 house,
Okay.
and so 56% of that would be about 150, 170,000, somewhere in there. So, okay. So for number's sake, $300,000 house, you qualified for 170,000. Now, what does that mean?
So that means you have the new rules. There is a new rule that has been put in place last year. Of the 170, you're going to qualify to get about 60% of that the first year, unless it's a mandatory obligation, unless you have those, that mortgage or liens that have to be paid off. At that point, if it falls over the 50% mark, you get an additional 10% of that principal limit to utilize for funds that you can use that year. After that, after the first year, you get the rest of the funds.
Well, and what if you just decide, I'd like an annuity for the rest of my life?
Yeah, so it has a calculation on there. So when we go through all those numbers, it'll show you this is the amount of line of credit, and this is those monthly guaranteed payments.
Now
And they can choose, and you can change it. So you're not stuck with what you choose at closing.
I see.
There's a $20 fee for them to change it, and then you can change it. So if you don't need that money, if you are getting those monthly amounts and you're finding that you're just not using it and that you're getting an excess amount, you can stop it, put it in a line of credit, make that change, no problem.
Now, the federal government, through the Housing and Urban Development Department, they're guaranteeing these loans,
They
correct?
are.
So
They are.
let's say that you have, again, your 62-year-old couple. They take this money out of their house, which is paid off,
Okay.
and you agree to pay them X number of dollars, just for round numbers sake, $500 a month.
Okay.
Okay. So after a certain number of years, 500 times 12 times a certain number of years, you're now taking out more than this 57% of the money, or you could wind up taking out 100% or 110 or 120% of the value of that house. What's the story with that?
So because it's a non-recourse loan, the loan gets paid off when you either move out of the home, it's no longer your primary residence.
Like go to a nursing home?
Yeah, you can actually be in a nursing home up to a year before they kind of have that conversation, and it's probably going to be a permanent situation, and then they'll accelerate that debt and say, yes, okay, now you owe it. But you have to live in the house, so it has to be your primary residence. So when if you sell the house, when the last person passes away, or if you change ownership in any way, so don't change that title in any way. Otherwise, they can call that note due at that time as well.
Mm-hmm. So at the time of passing of the last person on the title, when the reverse mortgage was made, what happens then? I mean, does this house get turned over to a realtor and just sold as normal?
No, not at all. So the heirs do have a decision to make at that point. They need to decide if they are going to keep the house or if they're going to sell the house. If they keep the house, then, conversation is key with those. Once you get to that point, the heirs, making sure that they're communicating with that investor is the most important thing. So they're going to want to know what they're going to do with the house. If they keep the house, then they can pay it off, whether they get a regular mortgage, life insurance, however, they pay it off and they keep the house. If they sell it, they sell it.
They do the selling,
the heirs will do the selling.
HUD does not do the
yes,
selling.
and I always encourage.
It's not like a foreclosure house.
Right. If there's equity in that house, then the heirs will want to do it because then they'll get that remaining equity. So there's no additional, they don't lose any of that equity. They've got 6 months to sell that property, but then they can apply for 2 extensions up to a year. So most hear, oh, I have a year to sell it. Well, it's 6 months and then 2 extensions that you have to apply for, to HUD to get those extensions, but it is up to a year.
And then well, obviously there's some formula at the end of the year of how that's dealt with then.
Yeah, the calculation and how the loan kind of happens is the loan balance is going to increase. So on a traditional mortgage, you're making that mortgage payment. So the principal and interest is going down. So your loan balance is going down. Well, it's the complete opposite with the reverse. Because you're not making those payments, the balance is increasing over time. So it's like any other loan. You'll get a monthly statement. They'll show what that loan balance is at all times. So you're well informed.
It's just the curious part about reverse mortgage, as I've learned, is that as this equity goes down, you can actually wind up owing more than the equity, than the value of the property if sold at market value.
Right, you could.
And so it is, I guess it is HUD that makes up the difference at that point?
It is. So that lender will put in a request for HUD to pay the difference so that the heirs are not responsible for that.
And that's guaranteed?
That is guaranteed,
so the heirs are not going to get...
Correct.
So that there shouldn't be a fear of mom and dad getting into this and then all of a sudden the kids or grandkids get stuck with having to pay monies that they didn't anticipate.
Right, exactly.
Okay, well, this sounds good. What other things do you talk about with people?
So you can use these for either a refinance if you have an existing home, but you can also use this to purchase a new home. So if you're downsizing or if you want that dream home, you can still use the reverse mortgage to do that. The amount that you put down is minimal. A lot of people at that stage of their life is either paying for a house outright. They've got the other house, they've sold that house, so they have all the cash. Well, this way they can buy that house, not have to pay all of that money, put a portion of it down, the reverse mortgage covers the other, and then they have that additional cash in their pocket.
But they have to keep the original house?
No, they don't. They normally don't keep the original house.
So what's the reverse mortgage on? That's on the
It's on the new primary residence.
Oh, I see. So you're buying a house,
buy
taking
a house.
out enough money in order to meet the 10 or 20% that's required to get a mortgage.
Well, it's a little different on the reverse.
I guess
so
it
on the
is.
reverse, you're gonna come in with a lot more money. So it's gonna be 40 to 50% down instead of your traditional down payment.
And then you're just.
But you're not having a mortgage payment. So with that, instead of buying the house outright, you're still getting to keep some of that cash. You're still not having to make a mortgage payment, but you are continuing, of course, with any reverse. Pay the taxes, pay the insurance, maintain the house, homeowners association fees, all that is still the homeowner's responsibility, and it has to be paid.
I think we need to go back over that to emphasize how important that part is.
Right.
One of the most important deals in all of this is that the homeowner must pay their property tax every single year.
Every single year. Property tax, homeowners insurance, maintain the house.
And they have to provide proof, I guess, on a yearly basis.
We're as a mortgagee clause on those policies, and so if it doesn't get paid, we're notified. So.
Okay.
Yeah, and that's very important.
Okay, so paying taxes, have to maintain your insurance on the house.
Yeah.
What else? Oh, utilities have to be paid for.
Right. I mean, you still own the house. The title is in your name, so you'll know you still own that house when you're making those real estate payments. So you still have to do the same things that you would, regardless of if you had a reverse mortgage or not. So.
And what other interesting things do you tell people?
So what's new kind of is that these are where in the past these were more geared towards need-based. We are seeing more towards financial planning based. So because of the way these work, financial planners are helping their clients and coming on board and saying, yeah, you can really use this as a financial tool, an additional financial tool. So they're pulling money out of the reverse because the money that you're pulling out of the reverse mortgage is not taxable income. Okay, so you have that's a big plus when you're looking at pulling money out of investments or out of that. You won't have that tax issue with having to pay taxes because it's not taxable income. But they're really
I guess that's even those monthly payments. They don't go towards your having to be reported as income
Correct.
for income tax
Right.
purposes.
Right.
It also doesn't diminish, as I read, eligibility for like Medicaid either when you're on
Medicare. So any
Medicare?
program, right? So if you have a Medicaid program, you've got to really watch if you're on public assistance Medicaid program. You do have to watch the amount of money that you're taking out of the reverse mortgage. But those are all conversations that we have. I make sure, hey, what do you have? We go over that so that we make sure that they're not messing up a program that they have, because we don't want them to lose those benefits.
I'll bet that there have been some people that have thought of ways to turn this to their advantage, and I'm talking about companies, and I guess the word is scam. Mm-hmm. This, to some people, could be like, well, when I first heard about it, I said, no, this sounds like a scam, right? Reassure people that this is not a scam and what to watch out for so that they don't get scammed.
Right. I always say educate yourself. Make sure that you're talking to a lender that is legitimate. I mean, I'm with Gershman. Gershman's been in business since 1963. So talk to someone that's been around the block. These are HUD insured programs. You should see the word HUD. You should see it in your documents. There's not a lot of scams really anymore. I think back in the day there were.
How long ago did this get started?
Oh gosh, this has been around since '89, I believe.
So this is not new.
No, not at all. I think it's obviously become more popular in the past 10 years. But
well,
no,
it's been
not
on television more. I
Absolutely.
mean, you've got some recognizable faces
Yeah.
that are on television.
Yeah.
Say, hey, call for this booklet or whatever.
Right.
And what do you say to TV commercials that say, call and get this booklet?
Well, I mean, it's great because anytime you can educate yourself on the program, get as much information as you want. I mean, I don't discourage anyone from calling to get the information. I like local. I like working local. I like using local. So I'm a local girl. So
So, I guess now is the time to. How did you get involved in this to begin? I mean, did you start in the industry in reverse mortgage, or where did you? How did you come to be in this?
So I started doing mortgages 15 plus years ago, processing regular mortgages. I started working with Gershman about 8 years ago. And about 7 years ago, they started really wanting to get into this program and have someone specialize in the program. So that's kind of
They
that was
pointed
me.
the finger at you and say, "Hey, Pam." It's
That's
like,
right.
and
I love it. I really love it.
did you
because
find it difficult at first to understand?
It is. It was. We've seen some changes. I mean, it's molded into what it is now. So there have definitely been some changes, and it takes a while to understand the program, and that's why that counseling is so important. I like people to come to me first so I can walk them through the program, and then they go through that counseling, and they're walked through that program again, and then they come back to me, and we sit and I walk them through that application. And as I'm walking you through that application, I'm explaining that program again. You may get sick of hearing it, but I believe that if you hear it over and over again, then it's gonna, because you can always pick up stuff that you didn't get in that first meeting.
Do you get people, or ever get people, or who come back and go like, "I don't like this. I want to get out," or not?
Like once they've done the application?
Yeah, not just the application. They've gone through the whole process, and it's like, I didn't understand that it was going to be like this. I mean, does that happen, or have you pretty well
I
got people
haven't-
covered and they fully understand all the terms before they get going?
They do. If I won't close anyone that I don't think understands the program. I think you're doing a disservice to my company ethically and to you. So yeah, I mean, you want to make sure that and I say, take your time with these. Educate yourself. Take your time. You don't have to make a quick decision.
So
if
this is
someone's
not-
forcing you to make a quick decision, sign. No.
So this is
Take
not like
your
something
time.
you're going to knock out in a week from
No.
the time that you think of the idea to the time
Right.
it's
No,
done.
not going to happen.
How long do you recommend that from the time they go like, yeah, I'd like to know more about that and maybe do it, to the time that they're finally signing the final papers?
It really depends. It depends on the individual. I mean, they may have been thinking about this for years and then just now got the information, so they're ready. But for those that just get the information, I mean, really read through the information. Have a couple conversations. It's okay to have a couple conversations, with your loan officer or with a counselor. Seek advice. Call on friends, family, your financial planners. Get as much. You can never over-educate yourself on anything. So
we got about 3 minutes left
Okay.
here. Is there anything we haven't covered that you think that you'd like to cover now?
So you've done a really good job.
Thank you. But we still got 3 minutes.
That's
So
3 minutes.
Yeah.
So, I just think it's important for people just to make sure that, we like to walk them through the process. And part of that process is the education, awareness, being aware of the program, educating yourself on the program, counseling. So then your next step would be that counseling, going through that counseling session. That counseling session is going to take about an hour and a half, roughly. It can be done over the phone or in person. And then you do the application. Once we do the application, then you're kind of walked through, we take over, we process that loan, it goes into underwriting, and then you get a clear to close. Once you get that clear to close, then at that time we have conversations. Okay, again, we're having those same conversations. Okay, we talked about this at application. You want X amount of dollars, or you want the line of credit. We confirm all of that before we go into closing. We kind of walk over those numbers so that you're not surprised with anything at the closing table.
This sounds very familiar, like the process of a regular mortgage.
It is. It's
too.
very similar. It's very similar. And from kind of start to finish, it takes about a month, depending on when some of those counselors are backed up. So from the point you get your counseling and your application, so from application to closing is about a month. So you are required, HUD does come in, or I'm not HUD, the appraisers do come in, they'll take an appraisal, they'll make sure everything's in order. So any repairs that may need to be made will be set aside if it's not a safety issue. So all that stuff is addressed during the whole process. We really, really walk you through step by step.
So people don't feel like they're alone in this.
No, not at all. Not at all. We don't just, hey, see ya. No,
Well-
it's definitely a walkthrough process.
Thank you so much for
You're
your time
welcome.
today. I mean, you've
Thanks for having me.
made this really understandable, and hopefully the audience has a much better understanding compared to the TV commercials that they've heard.
Right.
Thanks.
You're welcome.
And I've been speaking with Pam Gosser. She is a reverse mortgage professional with the Gershwin organization in Clayton. Her information has been up on the screen. If you, oh yes, this is going to be put on YouTube, so if you want to see it again, go to YouTube and look up her name and Conversation with Lee Presser. Thank you very much and goodbye.